A margin call is a notification from a broker or financial institution to an investor or trader requesting additional funds to be deposited into a margin account in order to maintain the minimum required margin level for an open investment position. It typically occurs when the value of the investments held in the margin account declines, and the account's equity falls below a certain percentage of the total margin required for the open positions, as specified by the broker's margin requirements. Margin is the amount of money or collateral that an investor must deposit with a broker to trade on margin, which allows them to borrow funds from the broker to purchase securities. The margin requirement is usually expressed as a percentage of the total value of the investment position. For example, if the margin requirement is set at 50%, then an investor would need to deposit $50 for every $100 worth of securities they wish to purchase on margin. When the equity in a margin account falls below the required margin level, a margin call is triggered. The broker may issue a margin call to the investor, requesting them to deposit additional funds into the margin account to bring the equity back up to the required level. This can typically be done by depositing cash or additional securities into the margin account. If the investor fails to meet the margin call, the broker may liquidate some or all of the investor's open positions to bring the account back to the required margin level, which may result in losses for the investor. It's important to note that margin trading involves leverage, which amplifies both potential profits and losses. Margin calls serve as a risk management mechanism used by brokers to protect themselves and their clients from excessive losses in margin trading. It's crucial for investors and traders to understand the margin requirements and risks associated with margin trading before engaging in such activities and to closely monitor their margin accounts to avoid margin calls.